Hi everyone, my name is Simon Mishevich from Optimize Accountants, and it must be April, so we're going to be talking about buy-to-let investment mortgages. And with me to do that, I have Simon Hodgson.
Hello.
So Simon, why don't you introduce yourself to the viewers?
I'll keep this brief. So everyone who's watching, I've been an investor for over 20 years. I've learned how to do all sorts of strategies and realize that your average broker doesn't necessarily understand investors, which is why I do what I do.
Perfect. And it's always good to know that we have a fellow property investor, not just someone who provides services. So that's great to know. In terms of the Bank of Interest rate, obviously that went from 4%. It went up by 25 basis points to 4.25%. Whether that will go up, what's your views before we go on to how it affects buy-to-let investors? But Bank of England rate 4.25%, where do you think it's going to go for the rest of the year?
That is a really great question. And this slide really illustrates that the Bank of England base rates, whilst going up, don't affect how lending goes out the door. So the markets have already priced in that they thought that this hike was coming. And we can see here from our 1 year, 2 year, 3 year and 5 year swap rates, actually, some of the rates have come down. So the 5 years come down, as has the 1 year. So unaffected by the Bank of England base rate hike. There was a small peak going back a couple of weeks ago when we saw the start of bank failures back in America, but that's now corrected itself. So effectively, we're still seeing some rate declines in terms of products in the marketplace, which we're going to look at next, I think.
Okay, let's go for it.
Okay, so this is a little summary of the types of lenders that will help us as investors get mortgages for the type of properties that we're going to do. So this is HMOs, service accommodation, bridging, refurbishment, etc. So we've got Shawbrook, one of the best players or big players in the alternative lending sphere, so tier two challenger banks. They've got a digital product that starts from 5.39, has a desktop valuation, so no valuation fees, and their full commercial products start from 6.49. Yes, they're more expensive than they were, but compared to where the rest of the market is, they're quite competitive. Probably the most competitive in the market space, Paragon, in at 4.8, and that covers HMOs, blocks of flats, as well as single lets. Bridging now from 0.75 a month is really cheap compared to where it has been, and refurb from 0.73 a month. And land
How does that compare if you're buying in single name versus limited company nowadays?
Do you know what? That's another really great question. It used to be that there was a massive difference. So effectively, single let properties in your personal name, we could have got those for 1.79, maybe 1.89 this time last year. And personal name would have been around 3%, so nearly twice as expensive. Now, Paragon at 4.8 in your limited company, and in a personal name, we might only be able to knock off 0.4 to 0.5% in terms of rate. So it's less than 0.75% difference. Massive.
It's incredibly, it's going to always be more of a competitive market for sure. So that's good to see that. And you're going to give us an example of HMO no cash left in, which is something that all property investors should be thinking about. No money left in a deal. So take it away. What is this property about?
Start again. The nirvana of property investing. So cash recycling, momentum investing, as we call it. So look at it. This is, as they call it, a bit of a non-looker. All the beauty is inside this particular property, because outside it is pretty ugly, I think we'll call it, for sure.
The roof lining, beautiful,
isn't it? Ex-local authority, non-standard construction, and effectively poorly laid out as 4 units. If we can move on to the next slide, Simon, to maybe show some of the numbers. So agreed purchase price of 405, even for that as ugly as this. It needed works to get lending, so it hadn't had its pre-formed construction updates or remedial works. And the works to turn it into a large HMO plus that remedial works came to a total of 380. Funding via SAS loan, so effectively the funding wasn't via us to start with. The exit lending was done by us. This was via a SAS loan lending to buy the project. A high-end internal finish. It needed something that I think I'll refrain from that term, but it's pretty poor on the outside. It needed to look great on the inside, and I think you're going to be stunned at the end value that we managed to achieve on this. Look at that end value of 1.17. It's a 12-bed HMO. This is on the outskirts of Bristol, but still in a really good high demand area. Bristol is one of the highest or the most preferred in terms of investors. By the time we'd done a mortgage, it was a little bit less than 75% loan to value because we came to do the remortgage right in the middle of the Liz Truss fiasco, and the lender was a little bit hesitant to give us a full 75% loan to value. I preempted that they were going to be a bit sticky on this. We'd started the application before some of the real rate hikes had happened. So we locked in a rate of 5.74, which is an absolutely fantastic rate in the current marketplace. Yeah. And this leaves just about some buying costs left in, which will be paid back over the first few months. And a net cash flow after all costs is £36,000 per annum. You don't need more than one or two of these to then give up the day job and become a full-time property investor.
I mean, just talking about the mortgage values that you're showing on the screen, a lot of the times it used to be the fact that properties and mortgages would be based on the bricks and mortar value. Is it this one very much based on do you work on the basis of commercial mortgages where it's looking at the rental of a property as well?
Absolutely, yeah. So this is a full commercial valuation. And even though the money had been lent by a SAS, the SAS wanted to understand the project to make sure it stacked up. So there was a RICS surveyor that went in, and we chose the RICS surveyor based on the fact that we knew that they would be on panel for the exit lender. So the same value are valued at purchase, even though lending was only via a SAS. We already knew what the NGDV was going to be based or come in at based on the rent that should have been generated for that area on a 12-bed HMO. It's all on one title, so therefore it had to get that commercial valuation. But specifically, what's really kind of key for here is over two properties. Each property was a 6-bed HMO, which meant that it didn't need sui generis planning permission. It only needed C4 planning permission, which was easier to get. But the whole thing on one title was valued as if it was one 12-bed HMO. And that's the secret sometimes to unlocking the full valuation.
That's amazing. Absolutely amazing result.